what's interesting, of course, is that we started the day thinking that we're going to get a big sell-off given how futures reacted to the CPI report.
Right, absolutely. And then the market opened and we go higher. I mean, I'm not sure there's a simple explanation for it. I think if you go back and look at when the correction started, obviously the narrative, the story then was higher interest rates, higher inflation, and maybe that was good for the first % or two of the drop. And then things just got out of control, got sort of irrational with the short vol trade blowing up. So I guess in the rebound, maybe it makes sense that we're, sort of not following the narrative either and sort of rallying despite these higher yields.
So on the Markets Live blog, did you guys have to delete all your posts right at 8:31? It's like, markets sell off on hot inflation data, delete all the... Actually, markets rallying because on further inspection.
Right.
No, but seriously, when there is a flip like that on the same data, what is it? People took a second look or what?
Well, again, I'm not sure there's a simple, easy explanation. I know I was kind of trying to think like an equity sales trader today, and there were a few stories that stood out to me that I probably would be sending out to my clients. One was that the story we had about the buyback, Goldman's buyback desk, really having an epic day during the rout. And also, it kind of went below the radar, but Apple talking about potentially, possibly raising its dividend in April. So to me, those sort of get back to the original tax cut theme, which is that, there's a lot of free cash getting freed up for returning money to shareholders through buybacks and dividends. I don't think we've seen, I've kind of been surprised that we haven't seen these big announcements yet. So, the thought that maybe they're still in the pipeline, I think, to me, is a pretty good reason to not get too bearish on this market.
So a taste of what's to come with other companies following suit, maybe?
Yeah, I was just going to say, if you're an equity sales trader, you just listen to your client and do what they ask you to do. You don't try and explain these markets, quite frankly, because it's just a license for disaster. Yeah. You have been looking at volatility, and I think that's the one theme that we keep coming back to here in the prospect that 2018 simply is going to be more choppy than we saw in 2017.
Well, yeah, clearly that's
so far it's playing out.
So
but you're looking at the spread between what's going on for the S&P 500 and for the Russell 2000 as well. And this is an interesting one.
This was interesting from Michael Purves at Whedon. And what you're looking at here is the spread between the VIX, which is obviously the gauge of implied volatility on the S&P 500, and the RVX, which is the VIX for small caps. And all that red is your typical pattern. And what it's showing is that the RVX is usually much higher than the VIX. So if you subtract the RVX from the VIX, it's usually below 0 in that red zone. And then you see that giant, unusual spike in green last week during the correction. And really, I don't think anyone needed more confirmation about the short vol trade blowing up, but this really kind of illustrates how crowded that was, and how it wasn't just crowded throughout equities. It was specifically crowded in large cap stocks, the VIX and all the VIX-related products. Now, the RVX actually has futures on it. I didn't even realize that. Don't tell anyone, but I didn't realize there are futures on the RVX, but they're very thinly traded, not a lot of open interest.